As the U.S. stock market is currently closed, we are looking at the closing figures from yesterday, October 30, 2025. Nuburu, ticker symbol BURU, ended the session at 0.3377 per share. That was a drop of 3.13% on the day, a loss of just over 1 cent. But the price itself is not the story. The staggering figure is the volume. Over 60.9 million shares changed hands yesterday. For a microcap stock with a market valuation hovering around $44 million, that is an almost unbelievable level of activity. That's not just noise, that's the entire float and then some churning in a single session. This is the kind of volume that signals a fundamental disagreement in the market, a war between two completely different narratives. When you see volume like that on a stock this small, it means something is breaking. The expectation many investors have for Nuburu is that it's a niche, high-tech industrial supplier. But the reality is that you are witnessing one of the most aggressive, chaotic, and high-stakes corporate pivots on the entire exchange right now. What's happening at Nuburu is a complete teardown and rebuild happening in real time, and the 60 million shares traded yesterday are the first shockwaves. Most people who have heard of Nuburu, if they've heard of it at all, think of it as that blue laser company. And for a while, that was the entire story. The expectation was built on their proprietary technology in high-power, high-brightness blue lasers. This was interesting because, as a matter of physics, traditional infrared lasers are poorly absorbed by reflective metals like copper, gold, and aluminum. This results in a lot of spatter and low-quality welds. Nuburu's blue laser, however, is absorbed extremely well by these metals, allowing for faster, cleaner, and stronger welds. The applications were obvious and compelling: welding copper foils for electric vehicle batteries, sealing components for advanced consumer electronics, and even 3D printing with metal powders. This was a technology that seemed perfectly positioned to supply the EV boom, perhaps welding components for a company like Tesla. It was a play on the guts of modern manufacturing, the kind of components that go into the supply chain for Apple stock products. It was a clear, understandable, albeit niche, growth story. But if you are looking at BURU today through that lens, you are missing the entire picture. The company that existed even 9 months ago is not the company that exists today. The reality is that Nuburu is in the midst of a frantic all-or-nothing transformation into a defense and security technology conglomerate. The blue laser business is no longer the focus. It appears to be the foundation, or perhaps just the publicly listed shell, being used to acquire a portfolio of companies in a completely different sector. This pivot is not subtle, it's a blitz. In the last several months, the company has created Nuburu Defense LLC to act as its new hub. From there, it has been on an acquisition spree, primarily targeting Italian defense and software companies. They've announced a binding agreement to acquire Orbit SRL, an Italian software-as-a-service company that specializes in operational resilience and crisis management. This acquisition is valued at $12.5 million, a significant sum for a company of Nuburu's size. They are also deep in the process of acquiring a controlling interest in Tecna SPA, another Italian firm that apparently has a substantial existing order portfolio valued at around $500 million and recently helped secure a $6.6 million contract with a government agency in Bangladesh. And just last week, on October 22nd, Nuburu announced yet another move, a strategic joint venture with Maddox Defense to develop advanced drone technologies. This is not a simple expansion. This is a complete identity shift, and it's being fueled by significant capital raises and accompanied by massive internal shakeups. In September, the company raised $12 million through a public offering, a move that was necessary to fund these acquisitions, but also diluted existing shareholders. This was on top of securing a $100 million flexible growth capital line back in June. To lead this new charge, the company completely overhauled its leadership. On October 1st, they implemented a dual CEO structure, appointing Alessandro Zamboni and Dario Barassoni to the top spots, each with a $440,000 base salary and huge grants of restricted stock units. This is where the story gets even more complicated, and the risk becomes glaringly obvious. This pivot has been so fast and so messy that the company is getting in trouble with the exchange. On October 13th, Nuburu received a warning letter from the NYSE American for being out of compliance with listing standards related to its low stock price and stockholders' equity. Just a day later, they received a second warning letter, this one for failing to provide the advance notification to the exchange before releasing material news, specifically the announcement of their new dual CEO structure. This is the reality check. That 60 million share volume isn't just excitement over the new defense contracts. It's a battlefield. On one side, you have traders, perhaps scrambling on the Robinhood app or using their SoFi active investing account, piling in on the news of a defense pivot, drones, and SaaS. They see a stock at 33 cents and dream of it becoming a multi-dollar defense giant. On the other side, you have institutional holders and long-term retail investors, perhaps managing their individual brokerage accounts at Fidelity or Schwab, who are watching this unfold with horror. They bought a laser company and now own a high-risk, cash-burning micro-cap roll-up that is diluting them with offerings and can't even seem to follow the basic procedural rules of the NYSE. This isn't a stable long-term investment like Nvidia stock, where you're betting on the growth of AI. This is a binary bet on management's ability to execute an incredibly complex series of acquisitions in a highly regulated industry, all while fighting to keep the lights on. The original business model, as we discussed, was sound on paper. The blue laser technology has legitimate applications. In a world moving toward electrification, being the best at welding copper is a great place to be. But the company struggled to commercialize this at scale. The financials leading up to this pivot were not strong, which is what likely forced the change. This wasn't a choice, it was a necessity. The company was facing a going concern risk, and this aggressive M&A strategy is a high-stakes gamble to find a new, viable path forward. This is not the kind of stock you put in your retirement account next to your Fidelity mutual funds or Fidelity ETFs. This is the definition of self-investing in the speculative end of the market. It's the kind of holding that more sophisticated traders, the ones using the advanced platforms at Interactive Brokers, would approach with extreme caution, likely using complex orders to manage their risk on such a volatile name. So, what is the future outlook here? This brings us back to the core tension between expectation and reality. The expectation being sold by the new management is that they are using the Nuburu shell to build a powerful vertically integrated defense technology company. They're targeting a $20 billion plus market in electronic warfare and operational resilience. If they can successfully integrate Tecna and leverage its $500 million order book, and if they can scale the Orbit SaaS platform, and if the drone JV with Maddox produces anything of value, then 0.33 cents per share will look like an absolute steal. The bull case is that this is the ground floor of a major new defense player, and the volume spike is just the smart crowd getting in early. This is what you hope for when you're looking for investment help or searching for ideas on investing sites. But the reality is that the risks are astronomical. This company is burning cash. The $12 million raised in September won't last long given the new CEO salaries and the cash payments required for these acquisitions. Shareholder dilution is not just a risk, it's a certainty. The integration risk is massive. They are trying to merge a US-based hardware company with multiple Italian software and defense firms, each with its own culture and operations. And the fact that the new leadership team immediately fumbled their compliance with the NYSE is a colossal red flag. It suggests a move fast and break things mentality that is ill-suited for the public markets and the highly regulated defense sector. This is not a stock you put in a managed portfolio, like Schwab Intelligent Portfolios or a SoFi robo-advisor. Those platforms are designed to avoid this kind of single-stock risk. This is a pure gamble on the new management team. The entire investment thesis rests on their ability to execute, and their very first actions have been sloppy. This story is one of the most dramatic on the market right now, and the outcome is completely uncertain. Comment below what you think is more likely. Does BURU successfully pivot and become a defense giant, or is this a desperate, high-speed cash burn into a delisting? Ultimately, the Nuburu situation is a perfect, almost painful example of expectation versus reality. The expectation was a simple, understandable, high-tech story about blue lasers. The reality is a complex, chaotic, and incredibly risky corporate restructuring. That closing price of 0.3377 and the 60.9 million shares traded represents a market that is completely and violently divided on whether this is an act of genius or an act of desperation. This is not a stock you invest online casually. This isn't a name you buy through your Fidelity mobile app or Robinhood stock trading platform and forget about. It's a story that requires daily attention, and it's a stark reminder